Hello everyone. Now, going forward on the glossary item, let us see what are the items that we have to see in balance sheet. What are the items that we find in a balance sheet? Current assets. Current assets are the assets that a company holds for a period of less than 1 year to meet its working capital requirement. They consist of cash and bank balances, marketable securities, inventories, account receivable, sundry debtors, loans and advances. Current liabilities. Current liabilities are the liabilities which have to be paid within a period of 1 year. Consists of creditors, bills payable, provisions to payment of dividends, interest and taxes. Then net working capital to sales. Net working capital, that is current assets minus current liabilities, divided by sales gives you the net working capital to sales figure. It is a measure of the amount of working capital required by the company to finance its sales. Then current ratio. Current assets divided by current liabilities, it gives you the current ratio. Then 1.33 is the minimum it should be. Inventory per days, number of inventory days, calculated by dividing 365 by the inventory turnover ratio, that is net sales by inventory. It indicates the number of days in which total inventory of the company is sold. The lower figure is better, higher figure is not good. Debtor days, calculated by dividing 365, that is number of days in a year, by the debtor turnover ratio, that is net sales by debtors. It indicates the number of days in which the company is able to collect its debt, or how quickly the debtors are converted into cash. Quicker the better, naturally. The net fixed assets is the amount of fixed assets in plant and machinery, less depreciation charges. Then share capital, issued by the share capital by the company, includes preference share capital. Free reserves. Free reserves are those reserves of the company which are available for distribution as dividend or a bonus. Important components of free reserves are share premium, general reserve, capital resumption reserve, investment allowance, utilization reserve, profit and loss, dividend equalization, export allowance, export profit, and export rebate reserves. Net worth in reserves in rupees. That part of the company which belongs to shareholders. Net worth includes equity share capital and all reserves less miscellaneous expenses and losses not written off. Net worth does not include preference share capital. Net worth is also known as shareholders' equity or shareholders' funds. The long-term debt is the amount of money that the company has borrowed and which it has to pay after a good period of more than 1 year. Then total assets is arrived by adding current assets, net fixed assets and other assets like investment and goodwill. It is the total items that are owned by it. An interest coverage ratio is the profit before tax plus interest divided by interest. It shows how many times the interest charges are covered by the profit before tax and interest. So how solid is the company, how much capable it is to pay its interest. Then debt to equity ratio is the long-term debt of the company divided by net worth and stockholders' equity. Debt to equity ratio varies considerably depending on the type of business. Normal companies debt equity is 3 and infrastructure companies debt equity can go up to 15. Sales to asset ratio is the sales divided by total assets of the company. This measures the efficiency with which the assets are being utilized to generate sales. Return on assets as a percentage is the profit after tax plus interest adjusted for the preference dividend divided by total assets at the end of the year. It measures how profitably the assets of the company are being utilized. And return on equity is the profit after tax adjusted for preference dividend divided by the net worth or a shareholder's equity at the end of a period. It measures the return on shareholders' equity and tells the shareholders how much money the company is making for them, no matter what industry the company is in and what is its asset size. All shareholders which rightfully want to invest in a company which has a high return on equity. Return on capital is the profit before tax plus interest adjusted by our preference dividend divided by the total capital employed in the company. It is net worth plus long-term debt. Capital will be equity plus debt. As at the end of that year or period, it indicates the efficiency with which the funds, whether shareholders' funds or borrowed funds, are being utilized. Okay, so these are all the items. Now let us see for a bank what are all the main terms that are used in a bank, because we will be investing more in banks. Price to book value per share. It is current market price divided by adjusted book value per share. For the banking sector, this ratio is more relevant than the PE ratio. In the case of a bank, capital is the asset, which is rightfully reflected in its net worth. When one adjusts the net worth for the net non-performing assets, the adjusted book value is derived. It is in this context that the price to book value gains very, very prominent. That means you remove the NPS. Therefore, you will know how much book value is left. Net interest income, that is interest income minus interest expense. It is calculated by reducing the interest expenses from the income earned in terms of interest on the total interest bearing assets. For a bank, interest bearing assets are its loans, and interest paying as liabilities are its deposits. Net NPA to advances ratio, net NPA divided by total advances. This ratio indicates the asset quality of a bank. It indicates what percentage of bank's advances are of poor quality, not paying interest, or in some cases the principal. Credit deposit ratio, total advances by total deposits. This ratio indicates the extent to which the borrowings are utilized for the purpose of lending activities. Interest income per share, interest income divided by number of shares outstanding. Interest earned by the bank in a period or a year is divided by the number of equity shares outstanding at the end of the year. Then net profit margin, this is profit after tax divided by interest income into 100 times 100. Net worth, equity share capital plus reserves minus miscellaneous expenses. Net worth is also known as the shareholders' equity or shareholders' funds. Net worth includes equity share capital and all reserves, including revaluation reserves, less expenses that are not written off. It is that part of the bank which belongs to the shareholders. Yield on advances, interest on advances divided by total advances. The interest the bank receives on its loans. Cost of deposits, the interest expended on deposits divided by total deposits. That is the interest the bank gives to the depositors. Capital adequacy, capital risk weighted assets. Capital includes the Tier 1 and Tier 2 capital. Higher ratio indicates the bank is in position to carry out larger quantum of business lending and vice versa. Because your capital to risk weighted assets ratio is fixed by Reserve Bank of India and based on Basel 1, Basel 2 or Basel 3. So it should be at least nowadays in Basel 3 should be at least 12 to 14%. Anything below 12 to 14%, the bank will not be able to do much of business. Interest spread, difference between yield on advances and cost of deposits. Advances, minimum interest spread should be at least 4% because 2% goes towards its management expenses. So only 2% will be left for any shareholders. Then advances, loans given out by the bank in the form of working capital or term loans. Retail loans are also included. Deposits, the money accepted from depositors in the frame of current account, savings account, fixed deposit, and all the other caution deposits. Then investments, money invested in assets other than loans such as government securities and other debt instruments. So these are all the items that you have to learn while analyzing different companies. Thank you for listening.